Hello, everybody, and welcome to today's episode of the Macrocast. I'm your host, Ylan Mui, a managing director at Penta. My co-hosts are Brendan Walsh and John Fagan of Markets Policy Partners. Our special guest today is a longtime friend of the pod, Brai Valerio-Esene, founder of public affairs firm SW4 Insights and a Penta alum. Brai, it's nice to have you back.
Thank you for having me back. Pleasure to be here.
Fantastic. Well, we go way back, actually, Brai, all the way back. I think it was a decade ago when we were both reporters covering the Federal Reserve. Back then, we were worried about negative interest rates possibly here in the U.S., so that definitely dates how far back our friendship goes. So I think it's only fitting then that we start our discussion today with Fed Chair Jay Powell's speech on the economy this week, where he tried to strike that balance between not indicating that rate hikes are imminent, but that they are still on the table because some of the economic data has still been coming in pretty hot. What did you think about what he said?
It was an interesting one because usually you try to get a sense of like, are they in a holding pattern, meaning rates are high enough, let's see what impact they're having based on the data that comes in. Or, you know what, we're not there yet. We need another one before the year's out just to sort of put us in that optimal spot. And I feel like, depending on who you are, you got that from, you got both sides of that from this one speech, which I think for those people who want certainty from the Fed is not necessarily helpful, right? Because there are those I've read who've said, oh, this means there is at least one more hike this year coming. And then those who have said, well, it seems more like they're waiting to see if the data keeps coming in strong or robust, and then that will push them to act. My sense is that based on his speech, I think Christopher Waller spoke this week as well. It does seem like the assessment is that not enough progress has been made to date. They still think inflation is too high. And they do believe that they don't want to get caught off guard by a few months of good news, so to speak, and declare mission accomplished too soon. And they probably see some room for maybe one more hike, just to sort of buy themselves some insurance, so to speak. And then I think after that one hike, whether it's November or maybe they skip and do it in December, then they hit the pause button again and see what happens in 2024.
I would say from the market reaction yesterday that the market, Powell's message was a little garbled. We had 10 basis point swings on the 10-year Treasury, which is not a normal thing.
Yeah, 10-year hit 5% at one point, right?
Yeah.
Highest level since 2007? Yeah.
4.9. And Treasury market is not a market that's supposed to swing that way.
Yeah, like to jump on Brendan's use of the word garbled. I think, Ylan, like you and I know this, like anytime as a reporter, when you first got the embargoed speech, right, you would go right to the end, because at the end is like the big paragraph that says...
Always read it backwards. Yeah.
Exactly. If you ignore the rest of this text, this one paragraph tells you the takeaway. And it was hard to do that with this speech, right? There was not that one big takeaway that said, yes, we're pausing, or no, there's one more hike coming. I totally agree.
Like halfway through it, you're like, oh, he just clearly said they're paused. And then 3 minutes later, he kind of takes it back. So he's trying to kind of have his cake and eat it too on this one.
But isn't that the kind of optionality that the Fed is trying to preserve, right? To keep markets on their toes, to say, we're data dependent. I did think it was interesting. There was one line where he described the conditions that could warrant tighter monetary policy. And he pointed to two things. He said evidence of persistently above trend growth, and that whether tightness in the labor market is no longer easing. So growth, what's happening in the labor market, not inflation directly, which I thought was kind of an interesting point, but how those two particular pieces of economic data could then feed into inflation, because the inflation headline numbers and even the Fed's own preferred PCE indicator have been kind of muddy because of what's happening in housing, what's happening overseas, and what's happening sort of geopolitically. So I thought those were two just interesting data points, because at least certainly in terms of tightness in the labor market, it hasn't been easing, right? It's been getting even hotter. Look at the blockbuster number that we got last month.
And the jobless claims are below 200,000 now. But going back to your point on housing, the housing numbers have been atrocious. The existing home sales in September were back to Great Recession levels. But then also within the CPI and the PCE, the housing component is still showing that housing is really strong in terms of inflation. So there's a lot of mixed signals in terms of the data, especially with housing.
Right. Yeah. And the inflation data that we saw that has come in pretty consistently with that headline bump from higher energy prices. And we've seen a little bit more encouraging in the core. But how the Fed is parsing that really isn't, they haven't really tackled that to some extent. And I think, as you said, Ylan, Powell sort of pivoted to talking about growth a little bit more. That's a nuanced shift above trend growth. That I think is sort of born of the retail sales number that came in this week, which was just eye-poppingly stronger than people thought. But, that looks lower. We're getting PMIs next week, U.S. Purchasing Managers Indexes. Those are supposed to be like pretty tame and into the, contractionary territory.
And also, John, on the retail sales, the data kind of got misreported. It was much higher than expected. But on a year-over-year basis, the retail sales are running at 3% nominal, which is actually negative in terms of real. So it's not like the consumer's out spending a horrifying amount of money. It's just kind of normal. But that number came in above expectations, where it just kind of shows that consensus Wall Street expectations are for the consumer to be weak, where the reality is it's coming above weak, but just the consumer spending normally, not massively above of normality.
And that's one of the things that I've found strange about the whole discussion around the economy, is that everyone keeps saying, well, the consumer keeps spending and keeps chugging along, even in the face of higher rates. But then you also read headlines that say, well, the consumers are also spending through their COVID savings. I'm like, if you're
which one is it?
You're not doing well, right? Like, if you're running down savings to keep up with spending, that's not a good thing. So I don't see how like higher retail sales necessarily means the consumer is doing well. It could be prices are higher. So of course prices are higher, the sales are up. Not necessarily because I don't think sales volumes are up. If that makes any sense. I think it's the prices that are up there that are driving that number.
No, that's a good point. We had John Dick on the podcast last week, in which he talked about the strong showing. Early indicators were that the Amazon Prime Day deals, people were shopping, et cetera. But he brought up the point, are people shopping because they're, ready to spend and, throw money on shoes and whatever it may be, or an Instapot, right? Yeah. Or are they spending during these big deal days because they're trying to save money and shop now when prices are, lower, retailers are having promotions on, versus, buy at an off cycle time when prices might be higher.
The other data point we are getting is people really are continuing to spend on the experiences. So it started, with Taylor Swift over the summer, but, NBA ticket sales are up 60% from last year. So I think that the consumer is kind of adjusting how they spend, and they have enough stuff, and there's a lot of kind of fun things to do out in the world. My daughters and wife are going to the Taylor Swift movie today, and they bought.
Are they dressing up?
Yeah, they got all their gear.
Oh, fantastic!
Cowboy hats and everything.
No, that's great. I mean, this brings up a larger point, which I thought maybe we'd hit later in the podcast, but let's just jump right into it. Which is, I feel like everyone has been waiting for the impact of higher rates to really hit the economy, and we kind of been waiting, and it maybe hasn't quite played out the way that everyone has expected. And is that because it just hasn't happened yet? Or is there something fundamentally different about how Fed rates, how the Fed controls and steers the economy, trickles down to the real world? Is the fact that we are so much more of a service sector economy now than we were 20 years ago, 40 years ago, et cetera, or whenever models were created, that Fed hiking interest rates doesn't seem to have the same impact? Is the Fed weaker than it used to be? I mean, that's a big question, but we're a big podcast.
I know. Brai, what do you think about that?
So yes, I do think that some of the problems with relying on macro data to make monetary policy decisions is that you don't always get that. Sometimes what you need is like a surgical view of like, okay, so writ large GDP is up this amount or sales are up this much, but is it a broad-based increase in activity, or is it just certain folks who are having expanded activity that then shifts the number upwards even though it's down elsewhere? And to your point, Ylan, I think the fact that the US is 70% or more services versus the rest manufacturing and goods producing. I do think in the goods producing sector, the increase in borrowing costs are probably being felt a lot more. I think manufacturing is probably dealing with the brunt of that more so than the services sector. I do also think when it comes to spending as well, you've seen a shift in consumer spending towards more services and less towards us ordering ovens and furniture and whatever else we did during lockdown, right? So I do think there's an aspect of it that what the Fed's trying to do might not necessarily transmit as smoothly to the real economy as it would have in the past. I also do think personally that a lot of things they're trying to influence can't be fixed with high interest rates anyway, right? Whether it's supply chain issues, whether it's, like I said, shifts in spending, whether geopolitics, right? Like if what's happening in the Middle East flares up even more and oil becomes more expensive, I don't see how high interest rates are going to fix that, right? So I think there are a lot of things that are happening in the world that are feeding through to economic activity and through to inflation that high interest rates cannot address.
Yeah, I totally agree, especially for the consumer, where, I mean, you buy a house, the mortgage rate, that definitely has been playing a big role. People are not buying houses. I guess the other big thing is cars, but, cars are much less expensive. Where I think it's going to be interesting is I think monetary policy works with a bigger lag than it used to. So what's going to be interesting in 2024 is, small businesses are you going to, hire 3 more people? Are you going to take out a loan and try to open a second location? I think that's where you're going to see the slowdown in activity, where the consumer is still going to be fine because you have a job, but businesses are going to be more reticent to expand.
The tightening of financial conditions for small and medium-sized businesses.
Both you're worried about, the economic future, but also it's just that much more expensive to take out that loan.
I also think that just structurally, the economy we have today is just very different from the economy of Volcker or Greenspan or Bernanke, right? Like Brendan mentioned cars. Like I live in a city where if I wanted to, I don't have to have a car. Right. There's Uber. There's all these other options of ways to get around without having to put money down on a vehicle. We're now in a society now where people are more comfortable living with their parents longer, right? Or living with roommates longer. So there's just shifts in how we do things now that place a lower priority or lower emphasis on certain things that would have been the case in the 90s or the 80s. I don't think monetary policy is necessarily adjusted or, moved with the times, so to speak.
Brai, one of the other things that you mentioned was geopolitics, and the landscape right now, obviously, is incredibly uncertain. We're looking at the violence that's happening in the Middle East as an example. Powell mentioned this in his speech this week. He called geopolitical tensions highly elevated, and he said that's a risk to the global economy. He even, I thought was interesting, kind of spoke out personally, not just as his role as Fed chair, but as a human, and called the attack on Israel horrifying. So I guess I'm curious because I'm trying to understand what the potential implications for oil prices and for consumers might be. It seems like there's been some swings in the market, but folks are still trying to figure out exactly how this could play out.
I mean, if it's too soon to tell. If anyone who tells you they know right now is lying to you. But you do see, if you follow the news closely enough, there are little flare-ups. You hear reports about, Israel and Hezbollah's, trading missiles and rockets back and forth over the northern border of Israel. I think I read that the U.S. destroyer had to intercept a cruise missile that was fired by Houthi rebels in Yemen towards Israel, right? So there's all these external actors who are sort of, inching towards potentially getting involved and making this a broader conflict than what it is currently, which would definitely have an impact on oil prices, especially if Iran gets drawn into this, right? because obviously they're a major player in the oil market. And then shipping, right? What does this mean for shipping? Will there be impacts on shipping lanes as well if a broader regional conflict breaks out? Because then you're not looking at just the impact of higher oil prices on, inflation, but also supply chain disruptions again that could happen. That's something to bear in mind. And I think just more generally speaking, because we're all in the business of advising businesses about how to navigate public policy. I think this is an example of how a changing global landscape is, creating so much uncertainty for CEOs, CFOs, COOs all over, because you're not only dealing with, how do we, adjust to, commenting on Israel or not commenting on Israel, or how do we, if we have business in the region, do we need to start making like plan Bs in case there's disruptions because a war breaks out, and then the knock-on effect on input costs, right? Because ultimately that's what drives a lot of this. And if your input costs go up, how much of that do you pass on to consumer? Like there's all, it's like the dominoes fall, and then, where are we after that? So I think it's a situation that bears watching. I don't think it's panic stations just yet, but there are a lot of ramifications that could have for the consumer at the end of the supply chain.
From a market perspective, one of the things when we see the world looking more and more dangerous and we see these awful headlines, there's this learned dynamic that we've seen in global financial markets since the global financial crisis, which is this good news. I mean, bad news is good news dynamic, right? Yeah. Where you have everything, the thinking is so Fed centric, and the idea the worse the world looks, the easier the Fed will be, which means, all else being equal, easier monetary conditions, better situation for risk assets. And so we've always seen this, this has been a very constant kind of dynamic. And at the basically, it was right at the start of this that we had a flicker of that, right? And it was, the treasuries rallied, right? It's a safe haven asset. Treasuries rallied. And there was a sense of comfort. Stocks actually began to rise in the aftermath of these horrible images. And then, we've seen this dynamic playing out over the last couple of weeks as this situation has progressed, is that, as the stocks haven't been great, there's been, risk aversion, but treasuries haven't rallied. And they've gone back to selling off. And now we've got the 10-year Treasury yield at 5%. Now, there are a lot of reasons for that. And, it's not the least of which is the Fed hammering home this higher for longer message. But, the sense that the world is getting worse and more dangerous. We're on the precipice of, potentially a wider war in the Middle East, and treasuries are selling off. Gold is rallying. Bitcoin is rallying. There's a sense that shouldn't, there should be more stabilization in the bedrock global safe haven asset of the world, which is, the 10-year treasury. And we've got the volatility of the treasury market is, close to the highest it's been all year. It's very elevated. We've seen, as Brendan alluded to before, wild swings in the 10-year yield while Fed Chair Powell was speaking. There's a reason that, when the role of treasuries as a safe haven has always been something of a shock absorber for, U.S. markets, right? When the world looks dangerous and bad, people, run to the safety of treasuries, and that brings yields down, which all else equal, gives you a little bit of a more favorable dynamic. That hasn't really happened during this last few weeks as the world has gotten worse, and these are the voices on the margins talking about how this is more nefarious a problem for the Treasury market that we're seeing. This is essentially the term premium blowing out because of deficits, rather than a more normal sort of pricing in of Fed policy. And I think the jury's very much still out on that. But when you see treasuries selling off and gold rallying, while the dollar is still high, that's a weird dynamic. And, when you see that kind of thing, there's a sense in markets that something's not right.
John, obviously they're not going to say anything publicly at this point, but do you think there's conversations behind the doors in Treasury, that they're concerned with what's happening in the markets in the last week or two?
Well, I think that there's going to be, obviously, behind closed doors at Treasury, there's a lot of discussion about the dynamics of the market. And, they're going to be, I would tell you for certain there's no panic, and what they're seeing is, being assessed and evaluated on a very analytical basis. But the idea that the Treasury and the Fed are kind of at odds here, and the idea that the Fed might, hike rates one more time, or keep markets on their toes and keep rates higher for longer at a time when, let's face it, deficits are large. And the president's speech last night, he had another appeal for more spending to support Israel and Ukraine. And, however you feel about those policies, that is another it's another drain on the coffers. And it's a challenging and it's something that is obviously like getting noticed. So, there's a tension in the markets there and it hasn't been good for risk assets.
Yeah, especially for, next year, irrelevant of what Congress does in terms of spending, Treasury is going to have to issue 20-25% more bonds to just simply because of the cost of interest.
Yeah, already the net interest payments are about 10% of the budget, I believe.
Yeah.
Fiscal 2023.
And we just, raised it by 3 times.
Right,
Yeah.
Right. I'm curious, too, about...
Actually, even more, because the Treasury issued in the good times, the Treasury issued a ton at the front end.
Right.
So it's going up a lot. It's going up like 3-4 times.
I'm curious, too, again, about the reaction in the Treasury markets. Is there any part of the thinking that, if this crisis in the Middle East continues to escalate, that will push up the price of oil, which then feeds into higher input costs, which could then result in a rise in inflation, which then would force the Fed to hike again, even in the midst of what is potentially a big risk to the broader economy? If inflation numbers are higher, is the Fed then forced to act? Is that part of the calculation at all?
That is an absolute horror movie that you just described. And we're in the Halloween spooky season. And that is, a very chilling scenario. The idea that the Fed has to hike rates is forced back into hiking mode by high energy prices that are based on geopolitics. That is, hiking into a worse situation, hiking into, what would essentially be a stiffening economic headwind. That is not what the Fed would want to do.
No, because the only way the Fed brings down oil prices in that scenario is to put us into a deep recession. That's the only way to do it. You don't say it out loud, but that's exactly what it's as simple as that.
But at the same time, we saw the Fed making that distinction between, the pressures associated with supply chains and commodities and that sort of thing. That was what they hung their hat on in the, in the transitory phase before 2022, and they got embarrassed. And so they're going to be really, I think, cautious to go, back to that well and try to make those distinctions between core and the energy and some of these other supply chain driven ones. It was an argument that didn't serve them well before. And now, you wonder if there's, if they're just sort of sweeping that under the carpet for now and hoping that oil prices stabilize and not make a big issue out of it.
No, but I think they would drive us into recession just to save their credibility.
Team transitory T-shirts are going to the bottom of the pile in the closet, right?
It's like Buffalo Bills.
Well, in an election year, I mean, this is the thing. I mean, if the Fed is faced with spiking oil prices due to geopolitics, and the economy is beginning to show some of the impacts of that pipe tightening that's in the pipeline. That's what Chair Powell said. There's a lot of tightening in the pipeline, and I think that though we have divergent opinions to some degree, there's a sense that we haven't seen the full impact of higher interest rates on the economy. That's probably coming next year, and it's an election year, and it's a very inauspicious time for the Fed, which tries to be an apolitical institution, to be, making really consequential rate decisions about the economy when you have the 2024 election, which will obviously be a very contentious one, it seems, looming.
Yeah, I think that's why, and I think listeners to this podcast who've heard me speak before probably not surprised. I'm very skeptical about a lot of things that policymakers do. I do think this is probably the first time, and this dates back, in my opinion, to the Bernanke Fed, where the Fed is truly data dependent, right? I felt like they said it before, where you kind of could predict which meetings there would be a hike and which meetings they would skip, right? But I think this time around, they are truly going to make it a meeting by meeting decision. I don't think there's anything that's like predetermined anymore.
John and Brendan, how do you see China fitting into all of this? Obviously, there are concerns that China could take advantage of the tension in the Middle East to make its own moves, and that would obviously result in. I don't even know how to. I'm running out of synonyms for the word turmoil, for the word volatility. Where do you see China fitting into the calculations, both for the Fed and the impact on the global economy right now?
Yeah, the story about China's reopening from COVID zero and the stimulative policies that Beijing had pivoted to, reawakening the Chinese economy, boy, have those been refuted. And we're in a situation where, pretty clearly the outcomes that they're looking for are elusive. That's not to say that the growth rates haven't looked a little bit better. We saw the data come in for September earlier this week, and also the third quarter GDP, and it was better than expected. Was it great? No. Can you completely trust Chinese economic data? No. Are there a lot of other signs? And so that's when you go and kind of look at the asset prices. Typically, if Beijing is getting some traction on its stimulus packages, you're going to see that in Chinese equity markets. You're going to see that in the renminbi stiffening against the dollar a little bit. You're going to see it in copper and some of these other traditionally, China growth-linked commodities and assets. And in general, what you're seeing is that these. If China's growth is stabilizing or picking up a little bit, boy, it's not registering in any of these assets. The renminbi is struggling to hold on to its weakest level since 2007 against the dollar. We just got a total retracement of the post-COVID zero bump in Shanghai Composite. It's been in a steady downtrend since the spring, and that's not just Shanghai Composite. That's in look across the Hong Kong and mainland listed Hong Kong stocks and mainland listed U.S. ADRs and that sort of stuff. It all looks really weak and trending poorly. So, the idea that Beijing is going to bail out the world with a big spurt of growth sure doesn't look right. There's always, they're on the other side of these big geopolitical problems. Are they going to be selling out treasuries to stick it to us? Well, the reality is that they're selling out their FX reserves for a variety of different reasons, and probably sticking it to the West isn't a top one. They're trying to stabilize their currency.
That's a really, really important point, because the media is kind of reported as, they're doing it for geopolitical reasons, and they're doing it basically entirely for internal economic, and especially trying to save their banking system.
But Ylan, you've definitely been telling scary stories in this. The idea that China could take advantage of this moment where the U.S. is essentially, its budgets are overextended. We're trying to support allies in two, significant wars. Is this the auspicious time for President Xi to try to gain his what people think is a prize that he wants in for his legacy in retaking Taiwan. It's a horrible thing to think about, but it really does have that tail risk element. It's in the back of people's minds for sure.
Yeah, I guess the way that I was thinking about it is, if China's economy is weak and its leaders are feeling vulnerable, what might it do to show strength, to project to the world that China is still a superpower, right? And that certainly can be scary, right?
I have another thought to propose to the group. And something that occurred to me recently. And it's similar to, I guess, what some folks have said as it relates to Germany and how a lot of their economic expansion was made possible by their access to cheap Russian gas. And then once the war in Ukraine broke out, sanctions, etc., no more access to cheap Russian energy, German economy starts to, have the hiccups it's going through right now. And so I'm curious with the US and how, a lot of consumers have gotten used to cheap goods, a lot of which was made possible by more trade with China and more, relocation of production facilities to China to take advantage of efficient, cheap labor. You now see policy shifting where there's more roadblocks for businesses to do business with China. There's more roadblocks to importing goods from China. And so as that shift begins, where businesses can no longer just have a factory in China, make it in China, and bring it back to the United States to sell, we start to see, again, back to the old input costs reference, costs going up. What does that mean for the U.S. economy going forward if we no longer have access to a cheap source of production for the things we make and the things we sell? What does that mean for our long-term growth prospects?
I was actually at the conference for the Export-Import Bank yesterday. So their mandate is very much to make loans to help the United States create supply chains outside of China. So it is something that the United States government is acutely aware of, and we are putting money behind it. It's growing slowly. Well, in the last 3 years, loans kind of went from in Africa from $10 million to 100, and last year they loaned $1 billion to Africa. So it is happening, but it does not happen overnight. And this is much more focused on strategic supply chains. It's not for your sneakers and for your washing machine. So that's going to have to happen independently. But you're right, Brai. If it does happen, it is going to drive up the sales of those goods. So the cost of those goods, sorry.
Yeah, I'm just going to ask another provocative question since I'm on a roll here, which is America first inflationary? Right? Are we moving production here costs more? Are we willing to pay more for goods that are made here in exchange, perhaps, for the stability of a supply chain that is either controlled by our fellow citizens or is controlled by friendly countries, right? Inshoring or friendshoring, one or the other. I'm not going to answer my provocative question. I'm just going to leave it out there for others to ponder.
Well, I mean, that's the direction I was going in with my comments. So thank you for closing the loop on that. I think it's a trade-off we're going to have to make, right? Like, if you want to do this, you want to build a very competitive domestic manufacturing base, you have to be willing to tolerate higher prices in exchange for that.
Brai, John, Brendan, what else is on your minds as you look ahead to the next week?
We don't have a Speaker of the House.
And we may not have one by our next podcast.
I think that's Brendan. The third most important job in the government, but we don't have one. Brai, who's going to be it?
Government dysfunction on display. It's very dispiriting.
That's the final scary tale of this podcast episode.
Scary stories abound. Yeah, next week we got the data calendar is U.S. GDP purchasing managers indexes from around the world. We've got European Central Bank, Bank of Canada, having decisions probably on hold with both. We've got a murderer's row of corporate earnings. We've got Microsoft, Alphabet, IBM, Meta, Intel, Amazon, ExxonMobil. It's a heavy-duty earnings season time frame. We've seen this week mixed results, Tesla face plant, but Netflix soaring. It's been kind of, hits and misses so far, and we expect that to probably continue. But, obviously in this environment, it's going to be all eyes on geopolitics, of course, over the coming weeks.
Yeah. As an economist, I've been really enjoying watching the MLB playoffs. Because there was two teams that spent the most money, over $300 million, and both of them finished last. And a lot of the teams that didn't spend quite as much made the playoffs. Brai, is there any scenario or situation like that in the Premier League where, a club spends a lot of money and underperforms?
All I can say is it's only October. There's still a long season to go. The Premiership doesn't end till May. So Chelsea has a lot of runway left still to make up ground and get their act together. That's all I'll say in response to that. But yeah, no, I'm with Jonathan. I think the geopolitics and the shuttle diplomacy that will continue to happen over the next few days and weeks, I think will be key to watch. Just again to make sure that we don't see external players, jump into the Israeli-Hamas conflict. I think that's where all eyes will be, for the foreseeable future.
Well, thank you all so much for the really interesting, sometimes scary conversation today. I'm Ylan with Penta. My co-hosts are John and Brendan from Markets Policy Partners. Brai was back on the pod again today, too. We hope you all enjoyed our show and can sleep at night after listening to this. Remember, you can always like and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.